Hello, all, and welcome to another episode of Market Pulse presented by SmartTouch. I'm your host, Aaron Fichera, and I have a great show for you today. Today, on my guest, Logan Sampsel of V.I.P Mortgage. Logan, good morning.
Good morning, Aaron. Pleasure to be here. Thanks for having me.
For those that don't know about VIP Mortgage, VIP Mortgage started in, I believe, 2006, based out of Scottsdale, Arizona, or the Arizona region. Since the inception, you guys have done over 28 billion in lending, making people's dreams come true with home buying, and now service over 39 states. So it's pretty amazing within a 20-year period. I know I was doing a little research on you guys, and one of the fastest growing mortgage companies in the country. So it's great to have Logan, one of the rising stars, on the show today.
Yeah, absolutely. We work really hard and we're very proud of what we've done so far and we're excited for the future.
Well, before we kind of, everything that's been on the minds of everybody is, of course, interest rates. We're now out of 2023. We're into 2024. It's that natural inflection point where we're thinking, okay, 2023 is behind us. What's going on? 2024 is the right time. And you add a little sprinkle of it's an election season. So that kind of turns up the emotional response to anything.
Absolutely.
Um, but I like to start off. Logan, when are you going to get Jerome Powell on the phone and cut interest rates? Is what I'm at. No.
I know I've been knocking down on his door and he just won't pick up. So we'll just take it as it comes and hopefully he's kind to us in the coming year.
I hope so. And we'll get towards interest rates. The current prediction is or forecast is three cuts, which is nice. I'm not as optimistic. I may be thinking more one, but let's get into that later on in the show.
All right.
Um, and to give the audience background, me and Logan met last year at a HBA event here in Austin. Big shout out to HBA. They put on a great event. Logan, you're a hell of a golfer too. So,
I don't know
uh,
about that. I think I got lucky a few times when we
eh,
met, but it was a lot of fun and I kind of came in as a third wheel and ended up having a lot of fun with you guys. So
as a ringer, and I believe you need to leave afterwards because you were carrying the team on your shoulders. So I thank you for that. But
yeah,
what I found very interesting was your background, and I start the show off where I want to give a little bit of background because we're all passionate about the residential, commercial, or just real estate industry in general. Logan, how does one become infatuated with becoming part of the mortgage industry?
I think that my story might be a little bit different than a lot of people's. Everybody has their own way of kind of coming into the mortgage space. The funny story with me is I grew up around it my whole life. So I was the son of a mortgage lender out in southern Arizona as a kid. Really, just from a young age, kind of grew up hearing about interest rates and loan programs and kind of through osmosis around the kitchen table learned whether I wanted to or not and picked up some stuff that I've carried my whole life. Went to college at Texas A&M. Actually had an offer to shoot on the Texas A&M archery team, but that's kind of how I got out here and fell in love with Texas. And throughout college, traveled a lot in the Central Texas region to all the rivers to fish and things like that, and just knew it's where I wanted to plant roots and stay. So continued on that path as a mortgage lender, and just absolutely couldn't be happier.
Excellent. Excellent, excellent. And I'm assuming as being a diehard Aggie, 90% of your photos have a thumbs up in them.
Yeah, absolutely. You have the good Aggie ring always on the finger, and it's always good to meet other people. I was states away over the holiday season and was sitting there at dinner, and somebody walked up and said, "What year are you?" And immediately we ended up hitting it off and having a conversation just because of the ring. So being an Aggie is something that's very, very special to me and something I don't take lightly.
Excellent. Well, let's dive into the meat of it. Current trends in financing. Logan, what can you share with us on some current trends you're seeing when it comes to home buying and financing?
Well, we're kind of in that interesting period in the real estate world. A lot of the root causes are going to come back to COVID, where there was just a lot of uncertainty. Real estate's very cyclical, as we all know, and COVID was kind of that perfect storm of rates hitting the floor as the Fed tried to keep money moving through the market. but even more so, a lot of people were feeling stuck in their living situation. People in the one bedroom apartments or people in the smaller homes with roommates or something like that. They realized they wanted something bigger. They realized they wanted something different, or just any combination of those things where they wanted to move. And I think that that's really what contributed to the boom was affordability was something that was really great because of interest rates being so low. And people felt pressured to, want to get out of the current situation that they were in because you love your home until you have to sit there 24 hours a day and do work at the kitchen table. Um, so that was something that a lot of folks realized. And, I think now we're kind of sitting on the other side of the aisle because the Fed realized that they may have opened up that flow of money a little too fast. We started seeing inflation and jobs really boom. And because of that, the Fed needed to use the power that they had to really just stabilize the ship. And, unfortunately, when you have highs, you also have to have the lows to kind of balance things out. And what it meant for us and for the consumers and everybody else in the business is mortgage rates hit highs that we haven't seen in a long time. And while at the time of recording things are certainly starting to get better, we're kind of mid to high sixes as of January 11th. But we hit eights just a couple of short months ago. So I think we're going to see a lot of buyers enter the market as the rates continue to decline. And as you said, the Fed predicts 3 rate cuts, and which would be great. It would mean a lot of buyers are entering the market. Um, it means that buyers will likely receive a lower interest rate, and that's great. It also means that buyers will probably see a little bit more competition, just because there have been so many people sitting on the sidelines trying to weather out this high interest rate environment. So the importance of, getting pre-approved and getting started early on in the process is becoming more and more important. But for our builders, it also means there's going to be a lot more people wanting to buy their homes, which is a great thing. So we all just have to take it in stride and take it as it comes. And, I think that getting through this season of high rates and trying to curb inflation is been a positive thing at the end of the day because we've all had time to sharpen our tools.
Well, and to that point, knowing these trends and these hurdles, what would be some advice that you would give builders or even on the buyer side as well, to kind of some alleviate some of these hurdles that we've dealt with maybe last year?
Really talk to the people that are in the know. Talk to your mortgage lenders, talk to your realtor friends, talk to the builders, because we really have to have a pulse on everything that's going on in the market. So as a consumer, just plugging in and understanding kind of the whys of why things are happening the way that they are and hearing from different sources is really going to give you the best idea of what's actually happening in the market because everybody has their 2 cents, right? But once you rub a bunch of 2 cents together, you kind of get the whole picture. Um, and I think that an educated home buyer is a better home buyer every single time. And just getting that education and talking to the people that are here to help is super important.
Well, and to that education piece, is there something a builder or developer can do to help um, reinforce or educate the buyer before they get to lending, or is there anything that we can be doing on the builder side would you recommend?
Yeah, I mean, I would say the biggest thing is just talking with people and getting to people to us early. Um, we don't know what we don't know until we know it. So if we can get in touch with those borrowers early on, we can build out better plans and kind of really tailor things better for them as they go through the process. Um, over the past couple years or so, we've seen people's budgets get stretched a little bit as affordability has kind of been hard. So, getting them in touch with a lender that might be able to help structure some debt in a different way and kind of put that game plan, even if they are, 8, 12, 14, 16 months out, talking with us early and often is going to be the best thing that they can do because setting the solid foundation is going to make everything else go up so much straighter.
No, no, I agree. It really, you can't go wrong with just more education. And to that point, you know, we're seeing a lot of new buyers into the market and a lot of terms, and there is needing that education piece. I get to work with Gen Z, and there seems to be a bit of a knowledge gap when it comes to where to start in the lending process. So, I definitely want to use some of this time to talk about mortgage options. You have fixed, adjustable, 30, 15, VA, FHA. Where do we start? How do what do you determine is the right criteria? If someone's interested in a type, how would you recommend and structure that? Can you kind of walk us through, well, how the sausage is made?
Yeah, absolutely. That's a great question. So, the mortgage industry as a whole is very broad. We have a lot of different programs, we have a lot of different solutions. And the reason for that is not one borrower is the same as the next. So, when we talk about mortgage as a whole, we're really talking about, kind of that made to measure custom suit maker, right? Is we're going to get your measurements for better or worse, you kind of your financial situation, your credit, things like that. And then, just generic facts about your life because, a VA loan is great for veterans. If you're not a veteran, that probably is not going to be the right fit.
Yeah.
And so, really just talking with them about what their situation is, what their goals are, and then we can take that holistic approach by figuring out what products might be a fit, and then really just helping guide them through the several different scenarios that are available to them in order for them to make the best decision at the end of the day. And so, we have some great programs that we're going to use and some great tools that we use that are going to show each of those, three, four, five options side by side so they can really get the best idea of what's going to be the best option for them. And then we can move accordingly. So, if anybody wants to see what those look like, feel free to reach out. We can send you some examples, or if you are a buyer, and you want to see what your specific situation looks like, we can certainly do that as well. But at the end of the day, it's all about tailoring the product to meet the person's needs and goals. Um, there's a lot of myths around the mortgage industry where first time home buyers have to be in an FHA program, which isn't always the case, right? Sometimes the conventional program is going to be a little bit better of a fit. And it's really just putting those two side by side and saying these are going to be your monthly savings if you go with option A versus B. You know, here's the long-term effects of going with one or the other. Here's the closing costs for one or the other. And then really just asking them what makes the most sense for you right now. Because if we can figure out your pain points early on, we can figure out the best route to go. Because if the cash to close number is, the biggest pain point and the biggest thing that's keeping you up at night, we can tailor that to bring that cash to close number down as much as we can. Where if monthly mortgage payment is something that you're worried about, but you have a little bit of a nest egg that you can invest in the real estate, we can leverage that to bring that monthly payment amount down if the cash to close number isn't something you're as concerned about.
Well, and to those points of criteria and kind of qualifying and identifying the right loan, are there any metrics that are still the standard? I know debt to income ratio is kind of a good metric that financing has always been around. Has that changed over the last couple of years, or are you guys looking at anything different that, maybe first time home buyers or those that are looking for a second home or third, do they need to be conscious of?
I think you hit the nail on the head for the most part. We're very interested in debt to income ratios, um, as well as, your just generic credit profile. Um, Credit score is obviously a big thing in the mortgage business and in lending as a whole. Um, it lets us get a really good look inside of really what's going on. And then the debt to income ratio can really support that. I think those are the two biggest things. Um, we're never going to make you a loan that we don't think you can comfortably afford. So that's where that debt to income ratio comes up. And then, depending on the property, depending on certain things, there are some benefits that you can potentially capture. So,
Are you seeing any trends around programs, that may be used higher frequently than others over the last couple of years, or any regionalism or demographics that's kind of stuck out in VIP mortgages analytics?
I think that over the last couple of years, what we've seen is a lot of first-time home buyers. First-time home buyers aren't very rate sensitive. The only reason for that is because oftentimes they're renting, right? They aren't living with mom or dad, and they're paying 100% interest regardless. They're not getting anything for the rental that they're paying each month.
Mhm.
The idea for them of being able to build equity, have that pride of ownership, own the home, is something that if they can afford it, they might be willing to swallow a little bit higher interest rate for the time being because we can always refinance later. And so that's going to be one of the biggest demographics that we're seeing really boom right now. That mid price is kind of one of the things that people have kind of held off on just
Mhm.
because rates are up a little bit. They may already have a low interest rate in the house that they're currently in, things like that. So they don't want to leave that real pretty interest rate to go into something else. But it's all about figuring out what the needs are because nobody buys or sells a house for fun. There's always a why behind it, and really it's just getting down to the meat and potatoes of what the why is, and then seeing if it makes sense. And to kind of talk on your point of what programs are being used most often, especially over the last year or so. We've been seeing a lot of temporary buy down programs really shine because the general trend over the last couple years is that rates will eventually go down. They won't continue to climb, and the Fed has really supported that in their conversations recently. And so being able to capture some of that saving early with the temporary buy down program, likely what we're going to see is those people be able to refinance before they hit that full note rate. And, so
No, and
that's
I think that that buy down, we've seen that as well as being a huge success across the board. And I think it kind of gives builders and new construction a leg up going into the 2024 market.
absolutely, that's something that the builders have done an excellent job of capturing is offering those incentives, funding those buy downs, funding some of the closing costs, and making the deal a little bit sweeter to begin with. And then, through the course of time, they're going to capture more savings again as they refinance. And I think that the new construction and the new builds have done a really good job of making the benefit to the home buyer almost unignorable.
Well, we kind of talked about standard metrics and, just the traditional when it comes to mortgage lending. How about technology? We've talked about being, through the '08 to now, you've seen kind of the gamut, especially being in the mortgage industry. What's some changes in technology, or is there anything on the horizon that's going to be a game changer?
You know, Over the last several years, we've seen a lot of automations come up that have really helped speed up the process and make the process less expensive for the borrower. Both Fannie Mae and Freddie Mac have both have incredible property data now. Likely due to the fact that there was so much purchasing going on. So a lot of that information is very vast and very recent. And what we're seeing because of that is we're seeing almost no appraisal. Sometimes we're seeing no appraisal costs. They have the neighborhood data down pat and they don't need to do an appraisal, or it's going to be a minimal appraisal rather than doing a full appraisal. Um, you know, and the other thing too is, we had to get a lot better at being online over the last few years. Just with COVID, it was kind of a necessity. And so we're seeing borrowers that are likely using online portals for most of their life. Think, banking, their payroll, all these things. And what we can do with the application process is if they're using a major payroll company, we can oftentimes get day one certainty through our automated underwriting. So what that's going to do is it's going to give us the income number that's signed off on. It doesn't need to be signed off on by an underwriter. And basically that's just one thing that we don't need to touch because we have such good data and the process has gotten a lot more streamlined. And so you can really get a firm loan approval on day one when we go through that automated underwriting system. And you can shop a lot more confidently because everything is already down pat.
It's pretty amazing. I mean, and I know kind of the buzz going, I mean, over the last few years, but especially going into this year's AI. And, I've had some guests on the show talk about AI's application in renderings, AI application in sales calls, even in our marketing efforts and how we analyze data. How is the mortgage industry still dealing in the 20th century, or do you see any application of AI, or is there currently rumors or murmurs of it being introduced into the financing world?
There are some rumblings. I think that we'll see it um, happen. I don't think we'll be first adopters of AI in the lending space. Anytime we're dealing with banking and everybody's money, we want to be slow to adopt things like that. But I think that AI over the course of, my career will certainly begin to play a more important role. I think our automated underwriting systems are going to become better just because of AI. Um, but at the end of the day, financing is not always very black and white. There's always, the it depends scenario.
Mhm.
And I think that if we can eventually get AI to that point, then our automated underwriting systems will be very, very good. Processing will be very, very good. But until then, until we can build out an AI that can understand the nuance behind financing,
Mhm.
I think that the need for people like me and the people like my team is not going to go anywhere.
Good, good, because that is kind of uh, the the crux of AI, that it makes the human intervention less needed, but then how do we backfill that?
Right. Absolutely. It's going to be, one of those things that as it gets bigger and as it gets better, it's just going to absolutely blow everybody away. I have no doubt about it. Um, AI is something that is certainly going to change the way that we lend. I just don't know when that will happen.
Well, I know we're going to kind of go into a larger discussion. And I know in our previous conversations, we've definitely have had some real barn burners when it comes to talking about the interest rate and the Feds and its role in just the markets in general. So, Logan, what's your thoughts on the recent? We talked about the forecast is three cuts.
Yeah.
There's a high percentage March, April as the being the first is what everyone's kind of touting around. What's your thoughts? What's the pulse on the ground?
I think that we will see cuts. I do. Before the Fed announced that they were going to predict three, the Fed futures market was predicting four. So the people that bet on what the Fed's going to do. Um, so I think that, we'll see some cuts. I think that as more jobs numbers come out, as more inflation numbers, as more PPI numbers come out, I think that we'll get a better idea of that, you know, as the data comes out. But um, I think that the Fed has done a decent job at curbing the inflation in the way that they wanted to. I don't think it happened nearly as quickly as they wanted it to. Um, but the Fed really only has one tool to play with, and that's the funds rate. And and so it's kind of hard when you have a very coarse adjustment lever to make fine changes in the economy. And that's just unfortunately one of the things that we're all along for the ride for. I think that we'll see rates begin to drop over the next year. Um, Now, do I think that we're going to see three rate cuts in the next 2 months? No. I think that it's going to be a very stretched out process because, we don't want the situation to happen again where we saw COVID, where the rate went to the floor very, very fast. And because of that, we saw that crazy boom that now is having to be cured in the to the tune of high interest rates. So I think they're going to try to bring it back in slowly and then hopefully find a new normal.
Well, I always hesitate about asking people to predict the future, and especially economists. What getting to that new norm. If you kind of look at the trajectory or it's been 7, 8% or something around that over the last 40, 50 years. We go back, we've conditioned a market around, well, free money.
Right.
So, I mean, where do you see is the new norm? Is it 5, 6, or should we be expecting 8? And just kind of this is a feel good moment before we get that uptick.
I don't think we'll see eight. So we have over 30 investors on our bank side that invest in our products and stuff like that. So we have a lot of different murmurings from a lot of different economists at those investors. The more optimistic ones are saying the new normal will probably sit anywhere between 4 and 6%. The more pessimistic ones are saying the new normal will sit anywhere from 5 to 7%. So as you think about that, the new normal being a swing from 4 to 7%, that's sometimes hard to grasp. But I think that if you throw a dart anywhere on that board, somewhere in the middle, where both of them think it could be, I think that's likely where we'll probably see it sit.
Excellent. Well, going into 2024 and seeing these trends, any advice or recommendations you would have for builders, developers around navigating this market?
I think just take it as it comes. Keep your head up, keep your head on a swivel. Um, the market is always going to be changing. We seem to get new news every single day, and the bond market responds accordingly to that. That's kind of that fine adjustment tool. Works very inversely to the 10-year treasury. Um, and I think that what we're going to see over the next year or so is just a lot of turbulence.
Hmm.
Every time an election year has come up, we've seen turbulence in the interest rate and in the bond markets, regardless of who gets elected. Um, and I think that as we see that, that happen with the fact that we're expecting the Fed to cut rates 3 times, there's just a lot of uncertainty sitting in the market. So really just keeping your finger on the pulse of what's happening um, is gonna be huge and very monumental for making decisions in the future. I'm happy to talk with anybody about what they think is going to happen and maybe what I think is going to happen. But um, if you have a question about what happened over the last week or so, give me a call. We keep a very, very close eye on the market and a very, very close eye on the why behind it. And so I would say that just keep your head up and reach out to people in your circle and people that you know that might have a different opinion than you or might share the same opinion. And there's strength in numbers and there's strength in conversation. So
Excellent. Well, you know, Logan, I know as we're wrapping up today's show, again, you always appreciate your take and the information you provide myself and the audience. Um, in closing, what are some resources? What are some go-tos that, Logan would recommend to the audience?
yeah, I think that talking with your real estate professionals, talking with the realtors in the area for the builders, the realtors that are selling your homes, the realtors that you work with, they have a very good idea of what consumer sentiment is in the market. They talk with a lot of people day in and day out. Um, that's their whole job is talking with people and figuring out what the general trends are in the market. They have a very good idea of what's going on. So talk with them, use them as a resource. In the same vein, talk with your mortgage professionals, talk with guys like me that have just been lending day in and day out. And so, from a resources standpoint is, keep your eye on the Fed futures market. That's going to be a good thing. Keep your eye out for those Fed meetings. Keep your eye out on the bond market. And, I think that if we all had the crystal ball of what exactly was going to happen, then we'd all be on Wall Street and making a
Yeah.
whole lot of money.
Yeah, we'd be having a different conversation right now.
Right. We're all along for the ride and we're just going to take it as it comes. And lending is not going anywhere. The housing market's not going anywhere. People always need a place to live. So I think that there's no panic. at least in the housing market. We're very cyclical, and we've seen these cycles before, and undoubtedly we'll see them again.
Logan, as always, I appreciate your take, and definitely as we progress through the year, want to have you back and line up our predictions and say, hey, are we just
Yeah,
crazy
we should
people?
we should do that. We should see if we were right or if we were totally off the mark, and then we can talk about maybe why or why not we were right or wrong. So I think that would be really interesting.
Well, I appreciate it, Logan. Thank you.
Absolutely, Aaron. Thanks for having me, and we'll get out and golf here soon, and
There you
maybe you'll give me a run for my money.
go. I'll try. I definitely need to shake off the cobwebs.
Absolutely, yeah. I'm looking forward to it.
Well, for those that are listening, thank you again for tuning in, and we look forward to catching you next time on the Market Pulse. Have a great day.